All right, welcome to the the investments review. We will have everything from previous chapters, so still cumulative, but we have these additional chapters. We skipped convertible bonds and options. We got commodities. We'll come back for options next week, or potentially Friday, depending on how far we get with other stuff. Same setup as the last exam, exam 2. 14 short answer. One of them will be that Barron's article, so you can have that prepared ahead of time. You know what you're gonna write. I'll need the title of the article, a summary of it, and how you would apply that. What's your takeaway? So how would you use this in financial planning? 4 calculations and 5 multiple choice. With those calculations, you will see those bond, yield to maturity, yield to call, taxable equivalent yield calculations, using our time value of money for the bonds, not going into the full bond function. So close enough where you would be able to get to the answer on the CFP exam, but it wouldn't get it as exact. Just recognizing the weakness in that. Why do we invest in 9?
To accumulate wealth.
Yep, trying to make some money. What is the relationship between risk and return, Marianne?
Risk, return's like what you get, and risk is like how much you're willing to give. Like the higher your risk, the higher your return, but the lower your risk, you're not gonna get as much.
Okay, good, but the key word for the return would be expected return. So if I take on greater risk, it's because I expect more return. We have no guarantees with these dollars. What about the 2 different types of risks that we've talked about? Anybody?
Some are risk tolerance and risk capacity.
Yeah, risk tolerance, risk capacity. Tolerance, that psychological, am I gonna freak out? And capacity, how much could I actually afford to lose? So with greater risk, we expect greater return. Risk is that we don't know the future. The possibility of loss, we don't know what's gonna happen with our investments. We can reduce risk through diversification. You have, I think on both of the last exams, told me the elements of systematic and unsystematic risk. This time I want you to do that actual chart. So I was kind of loose on what I said illustrate it, and y'all kind of did these other things that weren't exactly what I was looking for. This is what I'm looking for.
Well, you supposed to do it on the last exam?
What's up?
Or you supposed to answer that question like that on the last exam?
Yeah.
Oh, shit.
And then the elements of each, and tell me what they mean. So unsystematic, we can diversify that away through the business and financial risk. Systematic was those primes. I want you to be able to tell me what each of those things is and how it's going to impact, not just list them out this time. So each exam, I'm expecting a little bit more as we go on. And this is one of the big things I want you to leave this class with, the ability to create a diversified portfolio. And this is key in doing that. If you understand that, you should be able to create a diversified portfolio. The different markets we can get into. If we go long, we think it's gonna go up. If we're shorting the market, we think it's gonna go down. So we've got our bulls and bears. Bulls are charging forward, bears are hibernating. They might not be selling, but they're not buying. There's always a way to make money in the stock market, whether it's going up or down, or kind of maintaining. Different ways we can make orders. We have that market order. So you go to a restaurant, you say, I want the seafood, whatever, and you're paying market price. You're just willing to pay whatever it is at that moment. So if I put in a market order for a stock, I'm saying I'm willing to pay whatever price the market is charging right now. You know, we pulled up Google, we pulled up Rigetti, we pulled up some other individual stock with that random walk throughout the day. A limit order, I can say, I'm not willing to pay market price, but I will pay, a little bit less. So if the price drops down to that, cool, I buy it. If it never drops to what I'd be willing to pay, I don't buy it. With selling, same idea. I'm not willing to sell something I own for less than this price. And with both of those, I can say I want this to be good until I cancel it. So if this stock ever reaches that price, buy it or sell it, depending on what I'm doing. Or I could say good till the end of the day, good for 60 days. I can set it to be wherever I want. With margin accounts, I am using Vanguard's dollars or Fidelity or whoever else. So I'm putting up 50% of my own money and I'm borrowing up to 50% from that institution, Vanguard, Fidelity, Schwab. On the last exam, some of you were saying Fidelity was an example of a mutual fund. It's an institution that allows you to buy and sell stock, buy and sell mutual funds. They've created their own mutual funds. But when we get into that, I'll want an actual specific mutual fund or an area. So that margin account, they're putting up to half of it. If I drop below 25%, I made a bad choice, I'm going to have to face what's called a margin call. They're gonna say, put some money into the account. I'm paying them interest on what I borrowed, so they're making money either way. If it does well, I've magnified my gain. If it does poorly, I've magnified my loss because I used leverage for that investment. That 50% and 25%, those numbers I just mentioned, those are set by the government. The institution itself has to do at least that much. They could change it up. They're probably not going to, but they could. Different costs of that. Think of part of the costs as the taxes. So you don't want to day trade, or if you're going to trade frequently on something, do it within a tax advantage account. That way I'm not facing any capital gains. I might be paying a broker, I might be paying somebody for advice to put this together. As a financial planner, most comprehensive firms, we went and visited Welch the other week, they work on assets under management. So the dollars that they invest on your behalf, they're charging a percentage of that. So if the market goes down, they still get paid, but not as much as if it goes up, because that's more assets under management. So they have sort of the same goal. They want to grow your wealth. When we looked at those mutual funds, we saw returns that were based on the account was $1,000, now it's $1,500, that's 50% return. But it doesn't take into account your individual tax implications. Probably because they don't know. They don't know if this is in a taxable account, in a tax-free, so those Roth IRAs where we put after-tax dollars in. They just know, here's this mutual fund, and you could hold it in, any of those three accounts, or an HSA or something else. They don't know what taxes each individual investor might be paying. They just know that this mutual fund was worth $100,000, now it's worth $150,000. So they give you those returns like that, but they're passing those taxes and any other costs on. I'll kind of mention the parties. Regulation for the markets comes from the SEC. So the Securities Exchange Commission is going to make sure that everybody's kind of on an equal footing. We all have access to the same information, or we should. We did talk about some insider information with those efficient market hypothesis idea. So our weak, semi-strong, and strong form, where only in the strong form would insider information not give you an advantage to allow you to consistently beat the market. We're in a semi-strong market where inside information would allow you to consistently beat the market. But that regulation, the SEC, cracks down on it. IPOs, that initial public offering, these are going to be riskier than a company that's been around for decades. a company that has assets, that's been producing revenue, that's been doing all these things, we have a better idea of what's going on with it. IPOs tend to be very risky at first, meaning you could make lots of money or you're just tossing it down the drain. We saw, going back to the regulation, with Theranos, where they didn't have an actual product, but on paper, so the initial public offering, there's that shelf registration with all the information you might need in order to make a decision on whether this is something you should invest in. Their books looked great. They had funding, they had a Walgreens, CVS, these different places were going to carry their product. The problem is they just didn't have a product, or it didn't work. So they were, being able to test the blood and do all these results, but it wasn't through their thing that just did that pinprick of blood and could test immediately. They were spending more money than they were showing to get that. So the IPO more risky, not just because of that, but because it's untested. With the IPO, we had our different ways of going to the market. You're going through a financial intermediary almost every time because the company itself, their expertise is probably not going to be in IPOs. So you go to an investment bank, you go to a group of investment banks potentially, and they are going to either do best effort, meaning they're gonna do their best to sell all the shares. So they're gonna try to figure out, well, what should each share be worth? How many shares are you willing to put on the market? And then they'll figure out a fair price for that. The other way is guaranteed. So best effort or guaranteed, those investment bankers are going to say, I'll try my best, or I guarantee that all these will be sold. If they're not sold, I, the investment banker, will buy those remaining shares. So they're likely to underprice it in order to sell all. So more likely than not, the IPO, if there's an investment banker involved, they're gonna price it just below what it's worth or just at. They're not gonna try to overprice it because that would not be in their best interest. Time value of money. You may have a calculation there. I mean, well, actually, you definitely will with the bonds. So being able to solve for any one of those. We've done these. I think we've got them now. For the most part, those errors are lining up your payment with either present value or future value. So on this exam, I'll probably give you a way where payment is gonna be positive and a way where payment is gonna be negative, or better phrase, of where payment is gonna line up your present value. So I have $10,000 in a retirement account and I'm gonna put $1,000 a year into it. Those two would line up and my future value would be the opposite sign, because it's all going into the account. The $10,000 that I initially had in it and each subsequent $1,000, they're going into my investment account and they're growing to that whatever future value. With the bonds, we've had those payments coming to us. So my present value, I took it out of my pocket and I bought it. And then the payment and the future value are what are going to come to me. So if the bond, the payment and future value line up with that investment account that I just mentioned, my present value and payment line up. So thinking conceptually about where these dollars are going.
Are we gonna have a problem on the exam, almost like the worksheet we did last week, but the last problem specifically when we kind of tied in everything?
Exactly.
Okay.
So you'll have that, and then I'll set up something where you're going to be investing in an account, because I wanna make sure that you can line up your payment where it's supposed to go. So for the bonds, I'll have you probably calculate what is the current yield to maturity, yield to call, and I'll give you all the information you'll need for that. And then calculate a bond that's not taxed, some government bond, and figure out the taxable equivalent yield. So remember, there's two steps for the taxable equivalent yield. I'll give you the information on that government bond. Here's a coupon it's gonna pay you. You have to figure out the yield. So yield to maturity for the government bond. Then you take that yield and you do that second calculation. That yield divided by 1 minus whatever taxes your client is paying. And that is what you would compare to the corporate bond and the yield to call for the corporate bond to figure out what would be best for your client. Knowing that a yield to call, the call may never happen. Okay, so for whatever the household is that you're working with, they're going to have different objectives. They want to retire in 10 years, they are 40 years away from retirement. Wherever they're at in their life cycle, their goals for retirement, do they want to travel the world? Do they want to downsize? Do they want to move to be closer to grandkids? So wherever they're at in the life cycle, they may have different objectives, and these can change. They could have a goal of buying a home in 4 years or buying a new car every 5 years. We want to time those different things and think about where those dollars live. So if it's a shorter term goal, I probably don't want to lock it away into a retirement account. Although, if they are 65 years old, I could let that stay in that Roth account because they can take it out without any tax implications. Balance sheet and income statement, we've seen these with different words in financial counseling, in different classes you might have in accounting. Cash flows for the income statement, I just want to know all the dollars coming in and out. Just like in financial counseling, but here we are going to be looking at a longer time horizon. So when you get into your retirement class next semester, what are their costs? What are their cash flows going to be in retirement? Are they paying the same thing? Are they, updating their wardrobe to have these professional clothes to go to work? Or maybe that expense goes away and now we have all these trips and different vacations that they can take because they have the time to do it. So you'd be looking at cash flows for a much shorter term in financial counseling, where with comprehensive financial planning, you'd be looking, well, I'm preparing for your retirement 40 years away, let's get an idea of what your retirement's gonna look like. And those can change throughout their time. They get an inheritance, a divorce, different things can happen that can cause that to change, but we're trying to plan it out now as best we can. Just like with those returns that aren't guaranteed, we're doing our best with the information we have now, and we're updating it as needed. Balance sheet, that snapshot in time. I want to know their assets, their liabilities, and assets minus liabilities, net worth, figuring out where we need to be to achieve their goals. Diversification, talked about it, we'll have to draw that thing. Capital gains and losses. So we try to avoid paying taxes. The goal is to make money, and it's to make money for our client, not for the government. So we're thinking about where we place our investments. That diversified portfolio that meets their goals, if possible, I want to load my riskiest stuff. So the whole portfolio, some things are going to be riskier than others. I might have bonds or something in there that don't pay taxes. We'll put that in a taxable account and take advantage of its tax status, where it's not going to incur additional taxes, and it's probably going to have a lower return than maybe my actively managed index mutual fund. Those things that are going to come with greater risk, thinking I'm going to get more growth, that expected return because I'm taking on greater risk, I want to put that in my Roth as much as possible. And then I might move to the taxable account where I'm going to hold it for at least a year, so I'll pay long-term capital gains. And then if there's still no room, which would really not be possible because the taxable account, there's no dollar limits on that. Then that tax deferred account where I'm paying ordinary income. So your traditional IRA, your traditional 401k. Losses I can use to offset gains in taxes, and I can carry forward some dollars as I go through. Tax shelters, I mentioned, are tax advantaged accounts. The employer sponsored one is going to be one of the biggest sources of retirement income for most people. It doesn't have those same dollar limits per year. We're still limited on how much we can put in, but it's going to be much higher than what we can put into an IRA at that $7,500. With the, do you remember the other one I talked about, Daniel, that allows me to put after-tax dollars and it grows tax-free?
Like a FSA?
HSA, so the FSA is use it or lose it. The FSA, that's gonna disappear each year. And I'm actually putting aside all of those dollars. With the HSA, I even get a little bit of, potentially, I guess depending on your employer, a little bit of money from the University of Alabama. So I load mine up as much as I can, and the university puts in $400 for me. So all that I can invest however I want. It is reducing my taxes now, and it grows tax-free. So unlike the 401k where it reduces my taxes now, but it grows tax deferred, the HSA allows that to grow forever. And I can spend it without paying taxes on medical stuff until I reach, when was it, 62? When I get old, I can spend it on whatever I want. That efficient market hypothesis, already mentioned that. We got our weak form where all that information is out there, so there's only so much I can do with that inside information, and if I start going into some math and analyzing their reports on Edgar, maybe I've got an advantage. We pretty much say the only place that's gonna exist is in a brand new developing market. In a developed market like the United States, we say it's semi-strong, where the only way that you can consistently expect to outperform the market is with inside information. Active versus passive mutual funds. So last exam, this is where I had the issue. I asked for you to give me an example of an active mutual fund. And several of you just put like Fidelity or something like that. An active mutual fund could be created by Fidelity, but Fidelity also creates passive or index funds. So let's start with that. Passive fund is an index fund where they don't do much work at all to figure out what to buy or sell in that. They just look, here's an existing index, we're gonna match that. So we're not gonna charge you fees to put that together. We're gonna say, we're just doing that, now we get you in the fold, and you're gonna buy these active funds, you're gonna buy, sell, you're gonna play with options. You're gonna do all these things that make us money. The index fund is the way to kind of get you in the door. And it gives you this great broad exposure to the market. So the S&P 500 index fund, largest 500 by market cap, other than those bottom 10, 20 or whatever, they're gonna be decided by a committee. And then some other index funds that can follow small businesses, international, whatever flavor you kind of want to get into. You can have a mix of these passive index funds. For the active index funds, I'm sorry, I should say index. For the active funds, the Fidelity, the Schwab, the whoever, they've hired a bunch of people to figure out what to buy and sell within this. They have experts in that specific area. So this could be oil, gas, this could be healthcare, this could be whatever specific industry sector that they want to get into. They're going to charge you more for that because they have to pay all of these experts to put together this mutual fund. Unlike the passive, the index fund, that just mimics an existing index out there. So much cheaper to get into an index fund. The passive is going to charge you because they're putting more effort into putting that together.
So active is more expensive, passive is cheaper.
Correct.
Okay.
Passive is the index fund. It's going on an existing index, where active is going to be, I have to hire a bunch of experts, maybe they're flying to another country and actually going into this company, figuring out how their business model works, what the efficiency is, all those ratios we looked at, they would be calculating those, the leverage, the activity ratio, the profitability, all these things where they're trying to decide, should this be included or not? And then later, should we sell it or not? This is that chart that I've got up here. I want you to be able to draw this time. This is what I'm looking for that illustration. So when I say illustrate diversification, illustrate these elements, systematic, I'm accepting. I want you to be able to list each of those elements and say how they're going to impact my return, my client's return. Now with the business and financial, we had, I don't want to invest in Coke and Pepsi. I want two different types of businesses. If I do them, they're going to be, we looked at that correlation. maybe not perfectly positively correlated, but pretty close to perfectly positively correlated. They're gonna go up around the same times. We want a mix of things in different sectors, in different businesses, different types of things. If everything in your portfolio is going up at once, you don't have a diversified portfolio. There should be some things going down and some things going up. It's great if everything is going up, but that also means that one impact is likely gonna cause everything to go down. We wanna diversify and have a general upward trend over time. We talked about our beta, and you did those calculations for Alpha Trainer and Sharp. Beta is relative to the market we're comparing it against. So we have to make sure that we choose an appropriate market. If the beta of the S&P 500 is 1, which beta of the market's always gonna be 1, but I'm trying to use the S&P 500 compared to a bunch of small growth stocks, I look super risky. So if I was an advisor, I'm gonna look terrible in that one. I wanna choose something that's more appropriate to what I'm doing. I can gain that the other way and make what I'm looking at a riskier market. So some small business, let's say the Wilshire 3000, as opposed to the S&P 500 when I'm investing in something more conservative. Then I look great. So you always wanna make sure that you're lining up what you're comparing to what's similar to what is in your portfolio. Arbitrage was the finding something cheap in one market and selling it real quick. Because people do this, because everybody's trying to make money in the market, it makes the prices reflect what is accurate, the accurate view of the investing public. You have things like GameStop, where there was no underlying asset. People just saw that, oh, these hedge funds have shorted it, so if we buy it, they're gonna have to come buy our shares because they have to have them to short, they'll lose a bunch of money otherwise. So there can be situations like that, but usually it's based on the underlying value of whatever that asset is. Mentioned some of this already. Most of what you're gonna see with mutual funds now is going to be through an ETF, an exchange traded fund that allows you to buy and sell throughout the day as if it was a stock. Before ETFs came about, you would say, I wanna buy or sell it, whenever you're gonna do that throughout the day, but that would not happen until the close of business. So it'd always be at close of market, whatever it was. And these slides are in Blackboard. With the closed ends, this is the number we have. If nobody's willing to sell, you can't buy anymore. Open end is more likely where they'll just keep creating shares until at a certain point, we can't do this anymore. We can't achieve the goals of this fund because we've grown too much. So we're gonna close it off to new investors. You'll see like on Vanguard where they have Admiral shares and they'll charge you lower fees. Let's jump to advantages. So advantages, before I get into those fees, advantages of that mutual fund is I have these experts putting it together. If it's an index fund, instead of me having to try, let's say S&P 500 again, instead of me having to buy each of those and in a relative amount, so the top 10, your NVIDIA, Alphabet, Amazon, they're gonna have a huge chunk of that market. So it is all 500 companies, but they're not weighted equally because it's my market cap. So if Amazon does well, that's gonna kind of push all those other shares into doing something. So advantages, instead of having to buy 20 shares of Amazon and half a share of something at the bottom, probably less than half, of something at the bottom of the S&P 500, I have one share in the S&P 500, I have exposure to all 500. So I get broad exposure, and I can invest in multiple index funds and give myself exposure to different areas at a very low cost, as opposed to trying to pick and choose individual stocks, competing against those experts that this is their life, and they've got a whole team of people putting it together. So I've got that team working for me. I've got that broad exposure, I've got their record keeping of me being able to easily get into it or out of it, but I'm paying for it. So here's that load. You have the front end load where I'm paying a little bit extra at the beginning, a back end load that could disappear or be reduced if I hold on to that specific investment long enough. With the 12B1, I'm paying for them to advertise and try to get more people to pay. If it's actively managed, I am paying for all those experts to go do their different things. And we can see what the cost will be for each fund, all that combined into one number. When you go into, Fidelity or Vanguard or Schwab and pull up the mutual fund, you can see what you're paying for that, and it's gonna be charged once a year. Where do they invest? All over. Talked about those different sectors: healthcare, energy, financials, different specific sectors. It could be a mix. We talked about the target date funds that if I want to retire when I turn 80, it'll say, okay, what year you turn 80, that's your target date. So target date of when you retire, and it will automatically rebalance to be more aggressive when you're younger and more conservative as you approach and are in retirement. So I can just kind of set it and forget it and walk away. Others will say, I just will invest in the Pacific Rim, or I'm just going to invest in precious metals, or Matt's Bitcoin fund with Fidelity, where it's just looking at crypto. Whatever we're getting into, mutual funds are pass-through entities. That means that they pass all taxes, all costs, they get short-term capital gains, dividends, all that's passed on to the individual investor. If you're holding this in a Roth, doesn't matter. You're not paying taxes on it. If it is a traditional IRA or traditional 401k, those are being passed on, but it doesn't matter again because I don't have to pay taxes until I actually sell something out of that account. If it is a taxable account, I'm adding that on to my tax return every year. So the things that have been passed on to me. Dividends are almost always going to be long-term capital gain, unless it's a foreign company. But for domestic companies, it's pretty much always a long-term capital gain, probably at our 15%. We had our Alpha Trainer and Sharp. Alpha, go ahead, another, yeah. So all of these, we are kind of looking on a risk-adjusted basis. How did we do? So at the Alpha, we are saying, how did my portfolio do? Alpha, if it's positive, awesome, I outperformed the market on a risk-adjusted basis. If it's negative, I underperformed. And if it's exactly, like if it's zero, cool, I did the exact same thing as the market. But maybe I paid some fees for that. So return the portfolio minus everything in the brackets. What y'all tended to miss on this calculation is you have the formula, so you put things in where they were supposed to be, but then if you missed it, you missed out because of order of operations. So order of operations here, I go inside, so the brackets, and then the parentheses inside. So inside those parentheses, that's where I start. Return of the market minus the return of the portfolio. That's still inside my parenthesis. I multiply that times the beta of the portfolio. That was the step everybody seemed to miss. After that, you're good. So that answer plus the risk-free rate, and then I take my return, my portfolio return, and I subtract what I just calculated. So in that order, I need a pointer, something long.
Are we gonna be doing these on the exam?
What's up?
Are we gonna be doing these on the exam, or is it just the bond calculations?
You'll definitely have the bond calculations and the time value of money. You might not have these ones on this exam, because you did them on the last exam. So order of operations, return of the market minus the risk-free times beta, then add risk-free, and then all of that, what was in the bracket, you've got one number now, return of the portfolio minus that one number. That's alpha. We have an interpretation with that, positive, negative, or zero. We know whether we positive outperform the market on a risk-adjusted basis, negative underperformed, or zero did the exact same thing. With Trainer and Sharp, nobody messed up on the math of these, so order of operations great, but the issue was you didn't do it twice. Or maybe you, so with Trainer and Sharp, I need to do it for my portfolio and the market, or portfolio two, whatever it is I'm comparing. I have to do it for two different portfolios, and I have to match up the return of the portfolio, beta of the portfolio, there for Trainer portfolio. For Trainer of the market, I want the return of the market, risk-free rate's gonna stay the same, and I'm dividing by the beta of the market, or 1. Sharp, now we're using standard deviation because we don't assume that we have a well-diversified portfolio like we do with both Alpha and Trainer. Chapter 7, we'll go light here. I see I'm running low on time, so I'm gonna skip ahead to some of the more recent stuff. That's the bond market. Common features of bonds, we're gonna have that indenture that tells me what's the maturity date, does it have a call feature, what is the coupon. Generally the same sources of risk, but when we look at government bonds, the government can print money, the government can tax, they're gonna be less risky than a corporate bond. So a bond, I'm lending money to a corporation or the government, and they're gonna pay me interest. There could be a zero coupon bond, and then they're going to pay me at the end of the term, whatever that maturity date is, 6 months, 10 years, whatever it is, at the end of that, they give me that face value. If it's zero coupon, I'm not paying for it. We saw our math for this. You have the worksheet. You have infinite practice problems with the Excel file. Talk about different strategies with bond portfolios. We had our barbell, the bullet. We have, what else do we need to know with that? There's passive funds, so like an index fund with bonds, so you don't have to pick specific ones. But if it's in a mutual fund, they're passing the taxes on to you. Government bonds, note that they can print the money, they can raise taxes, they can do different things to make sure that you get the dollars. Open market operations is what we saw for one of the goals of the Fed. We want to, basically, if the economy is growing too fast, we want to take dollars out of your hands, so we're going to try to get you to buy bonds. If we want to put money in your hands, we are trying to buy bonds from you. So the buying and selling of bonds, it's these government bonds that we're talking about. Let's get through the math, as we saw that. We spent like 3 days on that math. Perfect, okay, so then we finish with commodities. If there's more time, I'll go back to whatever spots. Commodities, something that a unit here and a unit here is interchangeable. This is wheat, this is wheat, this is gold, this is gold. Doesn't matter where it came from, it's the same thing. So different types of commodities we can get into. And when we do this, we are speculating. We're either gonna be a speculator or a hedger. Hedge, pros, think hedge is the farmer. They have a guaranteed, I'm gonna be able to sell my stuff. So I know I'm gonna be able to sell it, and I know what I'm going to be able to sell it for. So this formal agreement is gonna say, I, the speculator, I'm gonna give you a little bit of money right now, so you get that, and you get this contract, and in 10 months, and however long, I will buy this much wheat from you for this price. the farmer can take that contract to the bank, they can borrow money based on getting dollars in, and they have less risk. If the price goes up, they miss out on that growth, like we saw with Cal and his farmer friends in California. But if it goes down, Cal will be out, the speculator will be out. So risky for the speculator, the hedgers not taking on much risk, but that means they also would lose out on the growth. The margin's that small amount that I put down, less than if we're doing a short stock. We paired this with options as well. With options, I'm out those dollars. I paid for that contract and I'm out. But I don't have to close the loop with the option. If it doesn't make sense, I don't have to actually exercise my option. With a commodity, this contract has to be closed. That farmer has to be paid. Now, I can sell off my contract to somebody else, and that's what usually happens. I'm a speculator, I'm buying it, and then I'm selling off that contract to somebody else, and I'm never actually taking delivery of the wheat or the whatever. So large profits and losses, riskier, both because I have to close the loop. So if suddenly, like, there's lots of soybeans, there's lots of whatever, and the price has gone down, well, if I made that contract 10 months ago thinking that prices would be better, who really wants to buy my contracts? I can still sell the contract, but it's not gonna be for as much as I was hoping to make. But I have to close that loop, where with the options, it's just that small amount that I put down to buy the contract, to buy the ability to buy if it hits my price. Our example, we got 1 minute, I can go through that example of Cal again, or is there something else that I skipped over you wanna talk more about?
Is there anything past this example?
You have brains in your head, you have feet in your shoes. You steer yourself in any direction you choose. You're on your own, and you know what you know. And you are the one who will decide where you go. What do you want me to go deeper on?
What's like another possible short answer question topic that we should really?
So you pretty much know what your calculations will be. Those bonds, so the current call and yield, taxable equivalent yield, with the taxable equivalent yield being that two-part calculation. I told you I'd have you do one where you're investing some dollars, just the time value of money, what's the future value of this account, or what rate of return would somebody need in order to reach a certain future value. The point of asking both those questions is I want you to be able to conceptually understand where payment is gonna line up. You all are getting the PV, present value and future value are opposite in sign, but I wanna make sure that you know where payment is gonna line up with one or the other, depending on what you're gonna do. With the bond, I'm receiving it, payment lines up with future value. With that investment example of I put $10,000 to account, I'm gonna add $1,000 every month. What's that gonna grow to over whatever period of time? Payment and present value will be the same sign. They're both going into the same account. And then potentially the Alpha Trainer Sharp, something there. Probably not all three, because that would be a lot of math, but maybe one.
We don't go over like GDP and stuff.
You wanna go over it now?
Yeah.
Yeah, so GDP is gross domestic product. We had ESIG for that. Our exports, our consumption. Go. Personal investment and government spending. And then all the stuff that we export out. What are you laughing at? CPI is the Consumer Price Index.
Measures inflation.
Yeah, so that basket of grocery goods But we can compare it to different places. And counseling, we saw how we could compare the cost of living in Chicago to Birmingham or to wherever you're looking at. The 3 goals of the Fed, accomplished through monetary and fiscal policy.
Oh, you want us to explain it?
No, I'm just,
Oh,
like, what do you want me to explain?
Nah,
I'm not asking questions now, we're over time. Y'all are welcome to go if you got places to go. But I'll stick around until people start gathering at the door. What else?
What's the difference between the, funds rate and the discount rate again? What are the?
Yeah, so there's that federal funds rate and the discount rate, and they're terribly named. The Fed is actually setting the discount rate, and that's the rate that banks can borrow from the Fed. The Fed funds rate is what they influence, that's what banks charge each other to borrow from another bank. And then there's the reserve requirement, where they can say, banks, you have to have this much cash on hand relative to your deposits. Others? All right, roll tide. I'll stick around for a minute.
I'm gonna have it check on Monday, and I forget.
This will be posted today.